Hello and welcome to another video on Ind AS, and today we are going to talk about Ind AS 110 Consolidated Financial Statements. In today's corporate environment, business rarely operate as standalone entities. Most organization functions through subsidiaries, holding structure, joint arrangements, special purpose entities, multi-location and multi-business groups. Therefore, understanding consolidation is critical because stakeholders are interested in the financial position of the entire group as one economic entity rather than individual company accounts. So Ind AS 110 provides the framework to answer some fundamental questions such as when does an entity control another entity, when is consolidation mandatory, how are subsidiaries combined into group financial statements, how do we treat non-controlling interest, goodwill and intra-group transaction. This standard ensures that consolidated financial statements present a true and the fair view of the financial performance, position, and risk exposure of the group. So, to understand Ind AS 110 in a structured and practical manner, let us just move to the first slide and look at the agenda that we're going to cover today. So, moving to the agenda slide then. Okay, now we'll quickly touch base the key agenda item that we're going to cover as a part of the Ind AS 110 presentation. So we're going to touch base upon the objective and the scope. We are going to look at the concept that what is the need for the consolidation. We'll also touch base some of the key definition, control model, potential voting right, investment entities exception. We'll also look at the key consolidation procedure, and we are going to look at the step-wise step, like what is the detailed procedure so that we can be able to conclude the consolidation properly. We'll look at the disclosures. So the disclosures are largely being managed under Ind AS 112, but still we are going to quickly give a snapshot of disclosure in this presentation as well, and then we'll quickly have a look at the comparison with IFRS 10 if any. Largely Ind AS 110 is converged with IFRS 10, but we'll still have a look at a comparative slide. So we'll start the presentation and move to the next slide. Now we'll quickly touch base upon the objective and the scope of Ind AS 110. So Ind AS 110 established principle for when an entity must prepare the consolidated financial statement. So conditions when the consolidation is something which is mandatory as per the Ind AS. How to identify the control over another entity. So which means that what is the concept of control, and we're going to discuss that in the upcoming slides, and how to present a single economic entity view. So typically objective is to make sure that if at all the conditions are met, then how we have to do the consolidation, the procedure, and then the financial statements that are going to be prepared are basis the consolidated financial statements, basis the procedure that is being laid down in Ind AS 110. A parent shall present the consolidated financial statement if it control one or more subsidiaries. Now, when we look at the scope is it applies to the parent entity and the subsidiaries, entities controlling special purpose vehicles, group preparing the consolidation accounts. And it excludes the accounting for the investment in associate, which is covered in Ind AS 28, joint arrangement, which is going covered in Ind AS 111, and then separate financial statements, which is covered in the Ind AS 27. So the objective is to make sure that whenever the entity passes the controlling interest test, then it has to do the consolidation as per the procedure which is being prescribed under Ind AS 110. So we'll move to the next slide. Okay, now when we talk about the consolidation in the previous slide, we understood that the objective is to make sure that whenever the concept of control has been established, then entity has to prepare the consolidation basis the procedure that has been prescribed under Ind AS 110. So, what is the need for the consolidation? The standalone financial statements show only the parent entry, but user need the group level picture, so that they could able to interpret what is the group revenue, what is the group assets and the liabilities, the true profitability, and the complete risk exposure. This is to make sure that as a group how the organization is performing, and if at all there are some gaps in terms of the performance that can be clearly highlighted. And this is to make sure that the entity which controls the controlling interest in the another entities, then what is the total revenue including those subsidiaries in which entity has a control. So for example, parent owns 100% subsidiaries, standalone investment showed at the cost, but consolidated subsidiary asset and liability is included line by line consolidation. While standalone is as per the cost method which is being there, but when we are talking about the consolidation method, then it has to be done. This is the line by line consolidation, which is the approach that has been prescribed under Ind AS 110. So typically, the need for consolidation arise because investors want to have the performance of the at the group level, and for that purpose, the consolidation is required at a group level for the revenue, assets, and liabilities to ensure that the true profitability can be depicted. So we'll move to the next slide then. Okay, now the key definitions which we are going to talk about, which are relevant for this Ind AS 110 is first is parent. So entity that control one or more entities. We'll talk about the definition of control in the upcoming slide. Subsidiary entity controlled by the another entity. Group is the consolidation, which is like parent plus all subsidiaries, and consolidated financial statement, which you normally call as CFS, is the financial statement of the group presented as it is for a single entity. So these are like key definition which we should keep in mind while we discuss this Ind AS 110 in detail. Okay, now this slide is very important slide because this is the crux of the entire Ind AS because this talks about the control model. Now, one thing that needs to be kept in mind that Ind AS 110 is talking about the control and not the ownership. So the relationship between the parent and subsidiary is not basis the ownership or the percentage of the share being held. It is basis the control which is being established by the parent over the subsidiary. So an investor control and investee in all the three conditions are met. So there are three conditions and we are going to look at all these conditions here. So first condition is power, second is variable return, and third is that link, which is like power plus return linked. So when we talk about power, what does that mean? So power means voting right, board appointment right, decision making authority in the agreement. So if these voting right or representation on the board or the decision making authority has been established, or it can be proved that this is there, then definitely the parent becomes the parent is having the control over the entity. Now, can investor direct relevant activity? Can investor direct relevant activities? So, example is like major voting rights. So, which means that key question that needs to be answered for a power is that can investor direct relevant activities? If answer to this is yes, then definitely it has been established that power is there with the investor, and that investor has also can take the decision on behalf of the investee. So, which is like example is like majority voting right. Now, when we talk about the variable return, the investor should have the dividend and capital appreciation, management fees, synergy, and all, and the residual interest on the liquidation. So, if that is something which is there with the investor, then it has the variable right to the variable return. So, is investor exposed to profit and losses? If answer is yes, then definitely it has that power, and then it has the right to the variable return. Then dividend entitlement is example of an outcome. Third, which is the most important, is to link between the power and the variable return. So link is power plus variable return. For example, company A owns 55% and can change pricing strategy by increasing the prices. It improves the profitability and the dividend. Company A uses the power to affect the return. So control exists. So which means that power is there, variable return is there, and then power plus variable return establishes a control to take the decisions basis which the organization can take influence the decision of the investee. So company A owns 55% can change the pricing strategy, which is one of the revenue making strategy. Then definitely it has a control over the another entity, which is that investor has a control over the investee. So can investor use the power to influence the return? If answer is yes, then definitely it has that control. So can affect the strategy. So this is called a three element control test, and all of three needs to be met before we can apply the consolidation procedure as per Ind AS 110. So example case, company A holds 55% voting share in the company B. Power yes, majority rights. Return yes, profit share, and link is yes. Conclusion, A control B, therefore we have to consolidate B with the A. So if greater than 50% voting right, subsidiary is usually yes. If less than 50% voting right, yes if control exists. So again, this is very important to consider here that the major majority right may not have the power as power in some cases. So in case the if power is even less than the 50%, but if the voting right is still less than 50%, but it has the power to control, the control and decision making, then still it can be the parent, and the investor will then do the consolidation as per Ind AS 110. And there are certain cases wherein there is voting power is more than 50%. Still, still the control is not there, and that typically arises when some sort of a stay is being there, which is being done by the court, or some regulatory matters say that consolidation is not to be done because decision making resides with the regulatory authority. Then in that case, even though holding company holds more than the 50% share, still it does not require consolidation because control or decision making resides with the regulatory authority and not with the parent company. And in this case, the Ind AS 110 should not apply. So which means what? Which means that the control model clearly ensures that the parent company should have the power, should have right to the variable return, and then that power should be linked with the control. So which means that power enables the parent entity to take the decision on behalf of the investee, and this is the control is there. And if even after the power, control is not there, then it will not be Ind AS 110. And similarly, in case of that power is not there, control is there, then it will fall under the ambit of Ind AS 110. This is very, very important, very, very crucial to ensure that entity should have the control over the another entity before it can deemed to be the subsidiary of the parent. So we'll move to the next slide. Okay, now we'll talk about another factor, which is the de facto model. In fact, we briefly touched base that in the last slide, wherein we said that even if the voting power or the representational board is less than 50%, still an entity can become parent if it has the control over the another entity. Now, this largely is a de facto control, which means that even if the majority shareholders is not with the parent entity, or even if the representational board is not there, still if the entity can able to control the another entity, then that entity will become the parent of the entity in which it has a control. So de facto control typically means what? So de facto control arises when the investor controls an investee even without holding more than 50% of the voting right. So control is assessed based on the actual power in practice, not just the legal ownership percentage. So when does de facto control exist? Ind AS 110 states that an investor may have a control with the significant minority interest if other shareholders are widely dispersed, other shareholders do not actively participate in voting, investor has the practical ability to direct relevant activity, and investor consistently dominates the decision making. So which means that if let's say an entity holds 40% share in the another entity, and the rest of the shareholders are widely spread and they are not participating in the voting, and this entity normally participates in all the decisions and the voting, then this entity will have a de facto control over the investee, and in that case this entity is deemed to be the parent of the subsidiary, and then it has to report the consolidation basis the process or the procedure that has been prescribed under Ind AS 110. So de facto control will give that power to the entity, and then it has to be done as per the Ind AS 110 procedure. So key indicators of de facto control is when large shareholder with a significant minority. Investor hold the highest stake compared to the others. Remaining shareholders are fragmented. No other shareholder has the enough power to challenge. Passive voting behavior. Other shareholders rarely attend or vote. Historical voting patterns support dominance. Investor has consistently approved resolution and ability to appoint the key management. Investor influence the board and the operation. So if all these conditions exist, then in that case, even though voting power is less than 50%, still that entity can become the parent of that another entity in which it has done the investment, and consolidation procedure will follow. So which means that this again substantiates the fact that the way in which Ind AS 110 recognize the relationship between the parent and subsidiary, it is not basis the ownership or legal ownership of the shares. It is based upon the control which can be exercised by the parent over the subsidiary. So we'll move to the next slide. Okay, now in this slide we'll touch base with couple of example to further understand that how that de facto control enable the entity to become the parent. So we have taken example, company A holds 40% voting power in the company B. Other shareholders, shareholder 1 holds 10%, shareholder 2 holds 8%, shareholder 3 holds 7%. Remaining public shareholders 35% are widely dispersed. No shareholder agreement exists. We'll quickly have a look at the voting pattern as well. In the annual general meeting, only 55% shareholder typically vote. Company A always votes is 40%. Others are passive and uncoordinated. Company A consistently appoint majority director. approve the budget and the strategy, directs operating decision. So conclusion is what? Even though company A holds less than the 50%, it has practical power over the relevant activities. Other subsidiaries cannot be block decision. And in this case, company A control company B through de facto control, and company B must be treated as subsidiary of a consolidated. And consolidation should happen as per the procedure of Ind AS 110. Company A should report group number by consolidating the company B as a subsidiary. Now we'll take another example. Company X holds 45% share, but another shareholder holds 40%. Shareholder actively participate, decisions requires majority approval. Company X cannot dominate the votes. So de facto control does not exist. Investment is not a subsidiary. So which means that we have a two set of shareholder. One shareholder has 45%, another has 40%. Both are equally participating in voting. Nobody is influencing the decision, and the decisions require the majority approval for all the stakeholders, shareholders. And in this case, even though 45% stake is there, still they cannot assume to be a de facto control over the another subsidiary, and hence it will normally be reported as the investment in associates. So we'll move to the next slides. Okay, now we are going to talk about another important concept with respect to Ind AS 110, which is the potential voting right. Which means that the entity has a convertible debenture which is being held in the investing company, or it has the convertible debt which is can be converted into the equity as per the agreement. So in all those cases, all these power give a kind of a potential voting right to the investor. So potential voting rights are rights that investor may have to obtain the voting power in the future through the instruments such as the share options, convertible debentures, convertible preference shares, or forward contracts to acquire the shares. So whenever these kind of contract exist, these contracts give a potential power to the investor so that they can become the shareholder of the investing company. So Ind AS 110 requires that potential voting right must be considered while assessing the control if they are substantive. So exercise currently or when decisions need to be made, investor has the real ability and intention to exercise, and no major barrier exists. So which means that whenever these kind of potential voting rights are there, then we have to establish the substantive rights which is there with the investor, and whether they exist. If yes, then definitely it will help the understanding, and then basis those substantive rights we can convert, we can treat the entity, and then that entity would having the control over the investing company. And we are going to illustrate it with an apple example. So we'll quickly look at it first. The what is when we have to evaluate the substantive right, that how we have to evaluate those substantive right. So whether right are currently exercisable. So which means that that option is given and that option can be freely exercised at any point in time. So which means that if yes, then more likely substantive. Economic feasibility, exercise price should not be so high that it become unrealistic. So which means that the price at which the option has to be exercised is to be realistic price. It should not be which is beyond the market price, which becomes very unrealistic to be exercised, and in which case the potential voting rights or potential equity would not be added with the actual shareholders being held by the parent entity to calculate the control over the investing. Third one is the barrier to exercise. So legal, regulatory, financial restriction reduces substantiveness. If these are not there, if there are no barriers, then definitely those potential voting right would be added to the existing percentage of share being held to calculate the control. And then purpose and the design of the investee right must affect the relevant activity. So we have illustrated it with the help of an example here. So company A holds 45% share in the another company B. Company A also holds convertible debenture that can convert into another 20% shares immediately. So which means that it can be converted, and whether rights can carry exist accessible, yes. So this is yes in this case. If converted, total holding becomes 45 plus 60, 20, which is 65. Conversion is immediately exercisable, economic beneficial, no restrictions. Company A has a current ability to obtain the major power. So conclusion, company A control company B must be consolidated as a subsidiary. So we have quickly shown three scenarios here. So majority shareholder consolidation is yes, because it is subsidiary. Minority shareholder but substantive potential rights, yes, it is possible. Minority shareholder but non-substantive right, then there is a no. So which means that if majority shareholder is there, then it has to ensure that they have the control, and if they have the control, then definitely it's a subsidiary. if minority shareholders are there and they have potential voting rights, and those potential voting right can be easily exercisable, then definitely it has the control over the entity and then it can be reported as subsidiary. If it is a minority shareholders, it does not have a control, and basis of substantive right also, there are no non-substantive right, then in that case it will not be reported as a subsidiary. It is normally treated as an investment in associates. So we'll move to the next slide. Okay, now we'll talk about investment entities exception. So typically what we have understood till now, that if an entity holds a percentage of share which is largely more than 50%, and then it has a control which can be established through the power, variable return, and then the link, then entity can largely be treated as a subsidiary. But there are certain exceptions, and what are those exceptions? We'll talk about that here. Normally, a parent must consolidate all the subsidiaries. However, Ind AS 110 provides a special exception to the investment entities, which are not required to consolidate certain subsidiaries. Instead, subsidiaries are measured at the fair value through profit and loss account, like Ind AS 109. And why it is happening like the way it is being mentioned here is reason because an investment entity is an entity that obtain the funds from the investor, invest solely for the capital appreciation and for the investment income, evaluate the performance primarily on the fair value. The sole motto of the entity, parent entity, is the investment is to make sure that they will get the appreciation basis the appreciation in the capital over the period of time, and they want to evaluate the performance primarily on the fair value basis. So which means that a typical example is a startup which is being funded by a parent entity. And in that case, even they are funding 100% of their capital by the parent entity. Still, that parent entity is going to disclose the investment as the investment at the fair value and as per the procedure which is being prescribed under Ind AS 109. And why is it so? We'll talk about that. We already understood because the investment is solely for the capital appreciation, and we'll talk about more in the upcoming slide as well. So investment entity typically includes like mutual fund, private equity funds, venture capital funds, and the real estate investment funds. So condition to qualify as an investment entity is that the entity is investment entities. All the following conditions are present. So business purpose: the entity objective is to invest in the return in the form of the capital appreciation, dividend income, and in both. Multiple investors are there. So entity has invested who investors and entity has an investor who pools fund and expect investment management services. Fair value measurement as the primary valuation, and the typical characteristics are indicative, not mandatory. More than one investment, more than one investor, investors are. So typically, the major objective of these entities to get the appreciation basis the fair value in which they have invested, and the objective is not to control the entity but to make sure that the investment are getting the returns basis the fair value assessment. And this typically happen because if a startup is there and then startup has multiple investors, or let's say the entity which is being investing in multiple startups, then in that case for each of these startups in which it has invested, it has to show as the investment as accounting as per the Ind AS 109, and it is there is no requirement to do the consolidation because the power is not there. Largely it is being main purpose is to fund that particular startup so that they can manage their activities. And why this is being done, why it is being treated the way it is, we're going to talk about it in the next slide. So let's move to the next slide. Okay, so we'll quickly talk about why this exception exists and then we'll come to the example. So we are saying that why this exception exists is because consolidation would distort the financial reporting, because investment entity do not operate business, they hold the investment purely for the returns. Fair value provide them better information to the users. Thus, users are more interested in the fair value of the investment rather than consolidation of the asset. So this is the primary reason why the intention is that though it controls the majority of the stake, still it is being shown as an investment only. For example, ABC Private Limited acquires 100% share in the startup X. Purpose is the capital appreciation. Startup X is a legal subsidiary. However, Startup X is a legal subsidiary. Still, ABC will not consolidate Startup X. Instead, it will record the investment in subsidiary at a fair value, which is as per Ind AS 109. Let's say investment cost is 50 crore. Fair value at the end is 65 crore. The investment in subsidiary would be inflated by 15 crore, and the fair value will go to the profit and loss account. So this is the treatment whenever the investments are being done with the major objective of getting the appreciations through the fair value changes rather than having the control over the other entity. So we'll move to the next slide. Okay, So now we are going to talk about the complete procedure of the consolidation, that how consolidation is going to happen, and this is the crux of the Ind AS 110, because we have understood when that control would be there, and then what is the concept of the de facto control. We also understood the concept of the potential voting right, and once we have established the control, then definitely question arises that we have to done the line by line consolidation of the subsidiaries or the child entities. Now, how that line by line consolidation happen, we are going to talk about that in the detailed slides here. So, consolidation procedure is before consolidation, the parent must ensure that the uniform accounting policies across the group entities, same reporting date or within the permitted gap, adjustments of the intra-group balances in the transaction, and the recognition of the non-controlling interest. So, how this consolidation happens, we are going to discuss that step by step. We have total 9 steps. We are going to talk about that each of these steps in detail. So combine the financial statements line by line. So parent and subsidiary financial statements are added item by item, asset, liability, income, expenditure, and the cash flow. This is the full consolidation. So step two, what we have to do, eliminate the parent's investment against the subsidiary equity. So whatever amount has been invested by the parent in the subsidiary, that will be eliminated by debiting the share capital and crediting the investment in the subsidiary. Because in the consolidation, that amount would be squared off. Whatever balance is there would be shown as a goodwill or a bargain purchase, which is largely the capital reserve, that will be shown separately in the balance sheet. So parent investment in a subsidiary is 160 crore. Subsidiary net assets is 150 crore. Difference is 10 crore, which is the goodwill. So what entry they have to do? Share capital reserve in subsidiary would be debited by 150. Goodwill would be debited by 10. Investment subsidiary would be credited by 160. Third step, which is the recognition of the goodwill and the capital reserve. So in the above case, we have already done that. We have recognized the goodwill by 10 crore because that is the gap between the net investment in the subsidiaries versus the price that has been paid by the parent to acquire that subsidiary. So goodwill rises when the purchase consideration exceeds the fair value of the net assets, and the consider, for example, consideration is 200 crore, fair value is 170 crore, so goodwill is 30 crore. It has to be reported as the intangible asset in the group consolidation. Recognize the non-controlling interest. So NCI represents the portion of the subsidiary equity not owned by the parent. For example, parent hold 80% of the subsidiary. Subsidiary net asset is 150 crore. So NCI would be 20% of 150 crore, which is 30 crore, which is shown as an under equity, which is equity attributable to NCI. So equity attributable to NCI is nothing but the percentage applied on the net assets of the subsidiary. That would be shown under the in the group report CFS consolidated financial statement. So we'll move to the step 5 in the next slide. Okay, so in step 5, what we have to do, we have to eliminate the intra-group balances. So all the intercompany balances must be eliminated, like receivable, payables, loans, advances, intra-group dividend, etc. So all these needs to be eliminated. So for example, parent receivables from the subsidiary is 20 crore, subsidiary payable to the parent is 20 crore. The elimination entry needs to be passed so that all the group elimination needs to be done before consolidation can reflect it true and the fair statement of affairs. So eliminate intra-group transaction like sale, purchase, profit, sale between the group companies are removed. So parent sold goods to subsidiary for 50 crore, profit included is 10 crore. So we have a closing stock of unsold, which is like 40%. So unrealized profit is 40% applied on the profit, which is there 10 crore, which is like 4 crore. Then we have to remove this intra-group transaction profit on the closing inventory by debiting the retained earning and crediting the inventory, because that is something which is unnecessary, distort the position. So we have to ensure that that should be eliminated before consolidation. Eliminate the intra-group dividend. So dividend paid within the group are eliminated. Example: subsidiary declare dividend of 5 to the parent. So entity needs to be entry would be dividend income from the parent would be debited, and the dividend paid subsidiary would be credited. So that will be eliminated from the group because it is like debiting crediting within the same group, and has hence needs to be removed. Then what we have to do, we have to allocate the profit between the parent and the NCI. So subsidiary profit is a split. So parent share and the NCI share is has to be obtained, and then we have to split that share between the parent and the NCI. Subsidiary profit is 20 crore, parent share is 80%. So parent share is 16 crore and NCI is 4 crore. So NCI profit shown separately in the consolidated P&L. The way we have shown the NCI in the net assets, likewise we have to show the NCI profit in the consolidated P&L. So we'll move to the next slide and look at the last step of the consolidation procedure. Okay, in the final step, what we have to do then, we have to prepare the consolidated financial statement fully. Finally, group prepares the consolidated balance sheet. consolidated statement of profit and loss account, consolidated cash flow, and the consolidated notes and disclosure. This is a quickly summary of the 9 steps that needs to be managed or ensured that how the consolidation is going to happen. So an entity has to follow these 9 steps to ensure that all the consolidation procedure should be is happening as per the Ind AS 110. So this procedure is prescribed by Ind AS 110 and needs to be adopted the way it has been described. So we'll move to the next slide. Okay, now we'll quickly talk about the disclosure. Though disclosures are largely going to get covered under Ind AS 112, but we'll quickly have a snapshot here to understand that what kind of disclosures are going to get covered. So disclosures are largely on the significant judgment in the control assessment, disclosure of the key judgment and the assumptions used to determine whether the entity controls the another entity. Example, control conclusion whether holding is less than 50% and de facto control, potential voting right, and the principal assessment. Group structure information, list of the significant subsidiaries along with the ownership, interest, voting right, etc. Non-controlling interest, detail of the NCI in the subsidiary, along with the profit and loss, accumulated NCI balance, summarized financial information, restriction on the subsidiary assets and cash flow, nature and the extent of the significant restriction on the ability of the subsidiary, and then changes in the ownership without loss of the control. Transaction where parent increases or decreases the ownership but retain the control must be disclosed. For example, additional acquisition of NCI or the partial disposure treated as equity transaction, but still we have to ensure that control is there. Loss of the control of the subsidiary, intra-group financial support and the commitment, protective rights and the significant restrictions, investment on the entity exceptions, structural entities, consolidation adjustment, and the reporting data differences. So why we are not covering everything in detail here, this is just a synopsis slide here because we are going to cover this extensively in the Ind AS 112 because each of the element is going to get covered in the Ind AS 112 because that standard itself talk about the disclosure of specific investments in the subsidiaries. So we are going to talk about that in the Ind AS 112. So we'll move to the final slide, which is the comparative slide. Now, when we talk about the comparison with IFRS 10, so this is largely a converged standard, and there are no principal or any conceptual difference with the IFRS 10 and IFRS in Ind AS 110. And when we talk about the disclosure, it is covered under Ind AS 112. Likewise, the disclosure of IFRS 10 is covered under IFRS 12 here. So this is a converged standard without any major differences. So we'll move to the final slide, which is the thank you slide and also the concluding slide. Okay, so as we come to the end of today's session on Ind AS 110, which is consolidated financial statements, let us take a moment to summarize the key learnings from this important standard. So Ind AS 110 plays a central role in the group financial reporting because it ensures that when one entity controls another, the financial statement reflect the performance and the financial position of the entire group as a single economic entity, which is very, very important. Through this presentation, we understood that consolidation is not based merely on the ownership, but percentage on the fixed. It is not a percentage on fixed percent threshold, but is driven by the concept of control, which is assessed through the power over the relevant entities, exposure to the variable return, and ability to use the power to affect those returns. We also discussed the critical practical areas such as the de facto control, potential voting right, investment entity exception, step-by-step consolidation procedure, treatment of the goodwill, and the NCI. The key takeaways that is that consolidated financial statements provide stakeholders with the transparent and the realistic view of the group overall financial health and the performance. So I would like to thank all my viewers and subscribers for watching this session video. I hope this presentation has helped you to gain a clear and practical understanding on Ind AS 110. So please let us know for any queries if you have in the comment section, and we are happy to answer them. We are going to come with the new Ind AS very soon. So until then, thank you, goodbye, and have a nice day.